Hi everyone, welcome back to the Investing Iguana, where we talk about all things related to personal finance and investing. I'm your host, Iggy, and today we're going to discuss a very interesting topic, CPF investment scheme, or Cpfis for short. If you're a Singaporean or a permanent resident, you probably know that CPF stands for Central Provident Fund, which is a mandatory social security savings scheme that helps you save for your retirement, healthcare, and housing needs. Every month, you and your employer contribute a certain percentage of your salary to your CPF accounts. There are three main accounts: Ordinary Account, OA, Special Account, SA, and MediSave Account, MA. Now, you might be wondering, what can I do with my CPF savings? Can I just leave them there and let them earn interest? Or can I use them for other purposes, such as buying a house, paying for education, or investing? Well, the answer is yes, you can do all of those things. But today, we're going to focus on the last option, investing your CPF savings. Specifically, we're going to talk about the CPF investment scheme, Cpfis, which is a scheme that allows you to invest your OA and SA savings in various financial products. But before we dive into the details of Cpfis, let me ask you a question. Why do you want to invest your CPF savings? What is your goal? Is it to grow your retirement nest egg? Is it to beat inflation? Is it to diversify your portfolio? Or is it just for fun? Whatever your reason is, you need to have a clear investment objective and a realistic expectation of the risks and returns involved. Investing is not a game of chance or luck. It requires careful planning, research, and discipline. And most importantly, it requires you to understand yourself, your risk appetite, your time horizon, and your financial situation. So, before you decide to invest your CPF savings under Cpfis, you need to ask yourself these questions. 1. How much can I afford to lose? 2. How long can I stay invested? 3. How comfortable am I with market fluctuations? 4. How much do I know about the investment products? And 5. How much fees and charges do I have to pay? These questions will help you assess whether Cpfis is suitable for you and what kind of investment products you should choose. Now that we've covered the basics of investing, let's move on to the specifics of Cpfis. What is Cpfis and how does it work? Cpfis is a scheme that allows you to invest your OA and SA savings in various financial products, such as A. Insurance products, B. Unit trusts, C. Exchange-traded funds, D. Fixed deposits, E. Bonds, and F. Shares. However, not all of your CPF savings can be invested under Cpfis. There are some limits and conditions that you need to be aware of. For OA savings, you can only invest after setting aside $20,000 in your OA. In addition, you can only invest up to 35% and 10% of your investable savings in stocks and gold respectively. Investable savings refers to the sum of your OA balance and the amount of CPF you have withdrawn for investment and education. For SA savings, you can only invest after setting aside $40,000 in your SA. These limits are meant to ensure that you have enough CPF savings for your basic retirement needs. To invest under Cpfis, you need to open a CPF investment account with one of the three agent banks, DBS/POSB, OCBC, or UOB. You also need to complete a self-awareness questionnaire, SAQ, if you are a new investor. The SAQ will help you understand your investment profile and preferences. Once you have opened a CPF investment account and completed the SAQ, you can start investing under Cpfis. You can buy and sell the investment products through the agent banks or other approved intermediaries such as brokers or fund managers. However, before you invest in any product under Cpfis, you need to do your homework. You need to read the product prospectus or offer document carefully and understand the features, risks, and fees involved. You also need to compare the performance and costs of different products and choose the ones that suit your investment objective and risk profile. Remember, CPF Board does not endorse any product providers or investment products that are included under Cpfis. You are responsible for your own investment decisions and outcomes. So far, so good? Are you still with me? If yes, then congratulations. You have learned the basics of Cpfis. But wait, there's more. You might be wondering, what are the benefits and drawbacks of investing under Cpfis? Is it worth it? Well, the answer is, it depends. It depends on your investment performance, your opportunity cost, and your personal preference. Let me explain. The main benefit of investing under Cpfis is that you have the potential to earn higher returns than the CPF interest rates. The CPF interest rates are currently 2.5% for OA and 4% for SA. These are guaranteed and risk-free rates that are adjusted periodically to reflect long-term bond yields and inflation expectations. However, if you invest under Cpfis, you can choose from a wide range of investment products that may offer higher returns than the CPF interest rates. For example, some unit trusts or exchange-traded funds may have annual returns of 5%, 10%, or even more, depending on the market conditions and the fund performance. Of course, higher returns come with higher risks. There is no guarantee that you will make money from investing under Cpfis. In fact, you may lose some or all of your CPF savings if the market goes against you or if the product provider defaults. You also have to pay fees and charges for investing under Cpfis, such as sales charges, management fees, brokerage fees, and agent bank charges. These fees and charges will reduce your net returns and may even wipe out your gains. Therefore, investing under Cpfis is not a sure-win strategy. It is a trade-off between risk and return. You have to weigh the pros and cons carefully and decide whether you are comfortable with taking on more risk for potentially higher returns. Another factor to consider is the opportunity cost of investing under Cpfis. Opportunity cost refers to the benefits that you give up by choosing one option over another. In this case, the opportunity cost of investing under Cpfis is the CPF interest that you would have earned if you had left your CPF savings in your OA or SA. For example, let's say you have $50,000 in your OA and you invest $30,000 in a unit trust under Cpfis. The unit trust has an annual return of 5% and a management fee of 1%. The remaining $20,000 in your OA earns 2.5% interest per year. After 1 year, your unit trust investment will grow to $31,350, $30,000 times 1.05 times 0.99, while your OA balance will grow to $20,500, $20,000 times 1.025. Your total CPF savings will be $51,850, $31,350 plus $20,500. However, if you had not invested under Cpfis and left your $50,000 in your OA earning 2.5% interest per year, your OA balance would have grown to $51,250, $50,000 times 1.025. Your total CPF savings would be slightly lower than if you had invested under Cpfis. But wait a minute. What if the unit trust had a negative return of -5% instead of 5%? Then your unit trust investment would shrink to $28,350, $30,000 times 0.95 times 0.99, while your OA balance would still grow to $20,500, $20,000 times 1.025. Your total CPF savings would be $48,850, $28,350 plus $20,500. In this case, if you had not invested under Cpfis and left your $50,000 in your OA earning 2.5% interest per year, your OA balance would have grown to $51,250, $50,000 times 1.025. Your total CPF savings would be much higher than if you had invested under Cpfis. So you see, by investing under Cpfis, you are giving up the guaranteed and risk-free CPF interest that you could have earned otherwise. This is the opportunity cost of investing under Cpfis. You have to compare this opportunity cost with the expected returns and risks of investing under Cpfis and decide whether it is worth it. The last factor to consider is your personal preference. Some people may prefer to invest their CPF savings under Cpfis because they enjoy the process of researching and selecting investment products. They may also have a higher risk appetite and a longer time horizon to ride out market fluctuations. They may believe that they can beat the CPF interest rates by investing wisely and prudently. On the other hand, some people may prefer to leave their CPF savings in their OA or SA because they value certainty and stability over potential gains. They may also have a lower risk appetite and a shorter time horizon to withdraw their CPF savings for retirement or other needs. They may be satisfied with the CPF interest rates as they are already higher than most bank deposits and government bonds. Ultimately, the choice is yours. You have to decide what works best for you and your financial goals. There is no one-size-fits-all answer to whether you should invest your CPF savings under Cpfis. So, to recap, here are the main points that we have covered in this video. Cpfis is a scheme that allows you to invest your OA and SA savings in various financial products, such as insurance products, unit trusts, exchange-traded funds, fixed deposits, bonds, and shares. You can only invest under Cpfis after setting aside $20,000 in your OA and $40,000 in your SA. You also have to open a CPF investment account with an agent bank and complete a self-awareness questionnaire if you are a new investor. The benefits of investing under Cpfis are that you have the potential to earn higher returns than the CPF interest rates and you have a wide range of investment options to choose from. The drawbacks of investing under Cpfis are that you may lose some or all of your CPF savings if the market goes against you or if the product provider defaults and you have to pay fees and charges for investing under Cpfis, which will reduce your net returns. The opportunity cost of investing under Cpfis is the CPF interest that you would have earned if you had left your CPF savings in your OA or SA. You have to compare this opportunity cost with the expected returns and risks of investing under Cpfis and decide whether it is worth it. Your personal preference also matters. You have to know yourself, your risk appetite, your time horizon, and your financial situation. You have to weigh the pros and cons carefully and make an informed decision. And that's it for today's video. I hope you have learned something new and useful about Cpfis. If you have any questions or comments, feel free to leave them below. I'll try my best to answer them. If you enjoyed this video, please give it a thumbs up and subscribe to my channel for more videos on personal finance and investing. Also, don't forget to hit the bell icon so that you won't miss any of my future uploads. Thank you for watching, and I'll see you in the next video. This is Iggy from the Investing Iguana, signing off. Stay safe and happy investing.